What do banks never say out loud? They won't tell you how tiny payments, sky-high interest, and hidden fees can turn your financial freedom into a lifetime sentence. But don't worry, because today, you're going to learn the 3 biggest tricks they use to keep you trapped. You'll hear one true story of how it happens, and most importantly, you'll discover how to escape. So, what exactly is a debt trap? It usually starts with good intentions. You borrow money to solve a short-term problem, maybe a car repair, a surprise bill, or a small emergency. The problem is, the system is designed to keep you paying long after that initial problem is gone. It's not just about the debt itself. It's the cost of that debt. We're talking about high interest rates, compounding interest, minimum payments, and a minefield of hidden fees. This is how a small loan quietly morphs into a long sentence, one minimum payment at a time. It's a silent, creeping problem that can take over your financial life before you even realize it. Let's pull back the curtain on the first trick, the minimum payment illusion. Banks market this as flexibility. They say, hey, you can pay less this month. But what they don't say is that this flexibility is a trap. That small minimum payment is just enough to keep your balance alive, potentially forever. Think about it. Imagine you have a $1,000 balance on a credit card with a 24% interest rate. If you only pay the minimum each month, it could take you 15 years to clear that debt. By the time you're done, you'll have paid double, maybe even triple, the original $1,000. That's not flexibility. That's financial quicksand. Every minimum payment is like taking 1 step forward and 2 steps back. The bank is happy because they're maximizing their profit, while you're stuck running on a treadmill, going nowhere. Now for trick number 2, hidden and compounding fees. Have you ever really looked at your statement? You'll find a whole buffet of fees. Late fees, over-limit fees, cash advance fees, balance transfer fees. Each one might seem small on its own, $30 here, $40 there. But they add up fast, and they start to multiply. And here's the real catch. Banks charge you interest on those fees too. So you end up paying interest on money you never even spent. Your balance can actually grow even when you've stopped swiping your card. This is how the trap tightens, silently, without you even noticing. It's a vicious cycle where fees generate interest, which can lead to more fees, and suddenly your debt has a life of its own. It's a masterclass in making money from your mistakes, and it's designed to be confusing. And that brings us to trick number 3, short-term loans and rollovers. You've seen the ads for fast cash, right? Payday loans, instant approvals, no paperwork. They promise immediate relief when you're in a pinch. But what they really deliver is dependency. A 1-week loan might cost you 10 to 30% in fees. If you look at that on an annual basis, that's an interest rate of 400% or even more. Here's how the cycle starts. When you can't repay the full amount, they offer to let you roll it over into a new loan. But all you're doing is paying a fee to buy yourself more time. You're not actually solving the problem. You're just renting it for another week or 2 at an outrageous price. Each rollover digs you deeper into the hole, making it almost impossible to catch up. Let me tell you a real story that shows how this all comes together. Meet Sara. Her car broke down, and the repair was going to cost $800. She put it on her credit card, thinking, I'll pay it off in a couple of months. But then, life happened. Her refrigerator failed. Her rent went up. Every month, she told herself, next month. Next month, I'll catch up. 2 years later, she was still just making the minimum payments on that credit card. To make matters worse, she had taken out a payday loan to try and get ahead. By the 3rd year, Sara had paid over $1,600 in interest and fees on that original $800 car repair. And she still owed most of the principal. This wasn't just a string of bad luck. This was the system working exactly as it was designed to. The minimum payments, The compounding interest, the lure of a quick fix loan, it all came together to trap her. Sara's story is a powerful reminder that these aren't just numbers on a page. They have real-world consequences for real people. So the big question is, how do you escape this trap? The good news is, you can. Here are 6 practical steps that work, but you have to start now. First, stop the bleeding. Stop using credit cards for everyday basics. Switch to cash or a debit card. You can't get out of a hole if you keep digging. Second, target your highest interest debt first. This is called the avalanche method. Make the minimum payments on all your debts, but throw every extra dollar you have at the one with the highest interest rate. Once it's gone, you roll that payment onto the next highest interest debt. Third, use balance transfers wisely. Those 0% introductory offers can be a great tool, but only if you have a solid plan to pay off the entire balance before that promotional period ends. Otherwise, the interest rate will shoot up and you'll be right back where you started. Fourth, negotiate with your lenders. Call them. Explain your situation and ask for a lower interest rate or a hardship plan. You would be absolutely amazed at how often they say yes. They would rather get some money from you than risk you defaulting entirely. Fifth, build an emergency buffer. This is crucial. Start with just $500 if you can. Having that small cushion of cash means the next time an emergency hits, you won't have to reach for a credit card or a payday loan. This is how you break the cycle. And sixth, get help early. There are non-profit credit counseling agencies that exist specifically to help people in your situation. They can help you create a budget and negotiate with creditors. Asking for help isn't a sign of weakness. It's a sign of wisdom. It's the smart move. If you're feeling overwhelmed and in debt right now, I want you to take 3 simple actions tonight. These can be your first steps toward freedom. First, freeze every credit card you don't absolutely need. You can literally put them in a container of water and stick them in the freezer. This creates a physical barrier to impulse spending. Second, get everything out in the open. Write down every single balance, every interest rate, and every minimum payment. Stare the numbers in the face. Clarity kills fear. When you know exactly what you're up against, you can start making a real plan. And third, make one call. Just one. Pick one of your lenders and call them. Ask about the reduced interest programs or hardship options. One simple phone call has the power to change your entire financial direction. Taking that first step is often the hardest part, but it's the most important. At the end of the day, banks don't necessarily need you to be trapped in debt, but let's be honest, they definitely profit when you stay that way. But now, you know their playbook. You understand the tricks and the traps. So start reading your statements carefully. Understand your interest rates. And most importantly, act early. Don't wait for the problem to become a crisis. Remember, knowledge isn't power until you use it. You have the knowledge now. It's time to put it into action. If this video helped you, please consider sharing it with someone you know who might be feeling trapped. Freedom begins with awareness, and you could be the one to spark that for someone else. Thanks so much for watching, and don't forget to like and subscribe for more content to help you take control of your financial life. We'll see you in the next one.